Hi there, in this video I talk about the 3 reasons why you should sell a stock. And only these 3 reasons. No other reasons. And impatience is not one of them, okay? And I've done that many times. Sold a stock where it's been going nowhere. I got impatient and I sold and it's had a massive rise. So I try and stick to these 3 reasons. These are 3 reasons I pointed out in my 10 lessons I've learned from small cap investing. In fact, you can see the video right there and then now top of the screen. But I go over that and I look at the stocks I hold and why I should still hold them. And also I cover a bit of news from the stocks this week. By the way, if you like this video, hit that subscribe button and notification bell if you want the next one to your inbox, all right? Okay, let's get into it. Okay, here's the boring bit. Anything you hear or see in this video is not investment advice. It could be absolute rubbish. Please do your own research. In the week I did this video, on average, how many trades do you do a month? The winner here was 70%, less than 10 trades a month. I'm quite impressed with that. I thought that's quite low, and that's very good. Because, of course, it's a cost of business. If you treat your investment, you should treat yourself like a fund manager, right? Pretty much. And the more you deal, and it's a business, you know, what you're doing. If you're making money, trying to make money on the stock market, it's a business, pretty much, okay? And now, the cost of sales, or, trades, is a cost of business. The more you do, the thinner your margins will get. Of course, I mean, look at 30 trades per month. 10% of people do that. Now, I don't know what your dealing costs are. Mine are about £6, I think, per deal. And so if I did, and I was doing that pretty much, topping up and doing that, messing around, and I was doing that amount, and that was going to cost me about over £2,000 a year. So that in itself, cuts the margins. When you look in businesses, I look for businesses that are quite efficient. They maybe are a brand, so they can charge a higher sort of amount for their sort of product. And I want big margins. Thin margins are really, associated with companies that are in very competitive fields, and they're inefficient, or there could be both, But the same with trading. The more you trade, the more your cost is going to be, the more time you take as well. It's also exhausting. Trading, investing is a lot easier. Sit there and do nothing and just have conviction. So in the last 2 weeks, I've done no trades. This is a record for me. I'm going to try and stick to it because it's hard work. But, I'm happy with what I got. These are the six stocks I own. There's plenty of upside. I think multiples of upside in each stock, and the sector diversified. So Escape Hunt, of course, it's 11 million market cap, 4 million cash. It's locked down at the moment, but they're growing very quickly. Very quickly, double digit. What I think year on year last year was before the lockdown was I think those UK sites 50% growth, 50, and generally the group 44%. So, and they can't open enough. So once they get back open, I've done plenty of videos on Escape Hunt. I believe pound, is a good target over the next 3 to 5 years. That's a cracking return. We're now at 14 pence. Gfinity, again, multiple upside share. This is esports. They're valued at sub 30 million. They're going to be a profitable company. Esports is huge. I know this from my kids. Listen, if I didn't have kids of a certain age, I probably wouldn't be holding Gfin now. But I see, the influence gaming and gaming stars and esports stars have on my kids. They don't watch telly. They never will watch that. We should drag them down to watch a Christmas film. They'll be playing games or watching gamers play games. That's the way it's going to go. Thematic investing, huge. Esports is getting bigger. They're in a hot space and it's very undervalued. Very good brand. All the big brands come to them to arrange esports. And they've also got their own sort of digital media company now. Media business building up quickly. Polarian, medtech, huge, unserved area. $150 billion a year in America spent on pulmonary sort of investigational stuff, and their tech is now it's hardly invasive. It doesn't damage anyone. It's way ahead of the current tech, and there's a massive market to be served. And just check out the board and people buying stock there. I think it's going to be huge. Polarian. If they do 1% of the entire market of the old tech, they take over 1% of the entire MRI market, right? They're worth over £1 billion. Salt Lake Potash, again, over £1 billion company on 3 lakes. They're planning to do that in 3 to 5 years. Again, resources on the market. I don't know if I'll go through a couple of slides comparing them with Rightmove, the market leader in a bit. But that's tech, of course, portal tech, and also property, which I like. And then I got Symphony Environmental. One of the biggest evils of our time is plastic, and they are making plastic smarter. So again, huge potential upside. Sector diversified. I'm happy with that. 3 reasons to sell. Try and stick to these. I've this is a rule. One of in fact, the 10 lessons I've learned from investing. Rule number 10 was discipline. It's easy to make rules. It's hard to stick to them. This is one of the things that I have problems with patience. I'm trying to conquer and get better as an investor. Reason 1, has the story changed? Is the reason why you're in the company still the reason why you're in the company? Or has that changed? Have they pivoted to something else because it's not really working out? Or something, has the board changed? Has there been a big change in the company? And no reason is that reason there. You initially invest in the company. If it is, move on. Maybe sell, because it isn't the business you liked in the first place. Okay. Reason 2, de-risk. If you've got too much in a stock, you may need to pull it back a bit. If it's literally, it's moving your entire portfolio, if it goes up or down by 1 or 2 percentage points, then you may want to look at it. But initially, this is the kind of risk and reward I hold. Imagine you've got stocks here. Let's say you've got 100 stocks, or 50 stocks, or 20 stocks, or 10 stocks. This is the risk and reward, okay? These are assuming all stocks are equally weighted in your portfolio. So 10 stocks, or 10% each, for example. Now, if you've got 100 stocks, and one stock drops by 100%. You've only lost 1%. That's good, you say. Yeah, very good. But look at the reward in that. If you get stocks that rise by one stock rise by 1,000%, you're only going to see a 10% upside in your entire portfolio value. What's the point of that? I'm prepared to take on more risk for more reward. So let's go down the value curve here. Let's say you've got 20 stocks, and one craters 5% of your portfolio value you've lost. That's all. If you get a 10 bagger, your portfolio value go up by 50%. I want it more than that. I can take on more risk than that. I can stomach more risk than that, but I want more reward, So my area is here. 5 to 10 stocks. At the moment I've got 6. I may want to have done a 5, who knows? Because then, if one of the companies craters and goes through bankrupt, hopefully I do my due diligence before this, but you can never say never. One company can go through. Who knows? It'll be some, it's happened with companies like particularly Valerie, where the CFO has been a bit dodgy or whatever. And one craters, 20% of the portfolio has gone down. It's a bit worrying. Sometimes that doesn't happen though. Even when you get an initial sniff of something going wrong, a company will drop, say 25%, 50%. So that even then you lose 5% value in your portfolio, or 10% value if it drops by 25, 50%. Now, what you get for a 10 bagger here, if you get a 10 bagger, it's hard to get a 10 bagger. It's very hard, I've had 3, but I've de-risked beforehand. But in my entire career, 3 stocks over 10 times, you get double your portfolio value if you're owning 5 stocks. To me, that's good. Risk-reward payoff there. I'm prepared to stomach this risk for this kind of reward. Again, if you go down this area, if you have one stock, it obviously lost all your money in one stock there, but you get all the reward as well. So, if you want to de-risk a little bit, then you can there. That's why I sort of start off with between 5 and 10 stocks. Efficient allocation of capital. And this is very important. Looking around for new stocks all the time, when essentially you've got some good stocks in your portfolio, is the reason why I think most people start getting impatient. And if their stock price isn't moving, look at the potential returns of the next 3 to 5 years. Are they still there? Are they still possible? Yes, they are. Then hold on to the stock. If they are, hold on to the stock. Don't just sell. Impatience is a bad thing. Sometimes I've seen, in fact, recently on Salt Lake Potash, for example, there's been some people on bulletin boards. I never, ever, in my entire life, I've never, ever paid any attention to bulletin boards. Every now and again, the last time I went to a bulletin board was about 3 years ago. And because I was researching a stock, couldn't find much information on it really, and I want to see if anyone had anything on the bulletin boards. Nothing. Or people just arguing or de-ramping or ramping. And sometimes you get involved in that and you can worry yourself out of an investment when it's all opinion. You get people de-ramping on there. Just stick to the company's news, and look at their presentations. Just stick to that. For example, Salt Lake Potash. So some people worry about the environment permitting and all that and the funding. Don't worry about that. That's what the board are paid for. These guys have done it before. They built mines, big mines, made lots of money. That's what they're there for. And like I said, as far as environmental permitting is concerned, it's got green label certification, and they've got the Clean Energy Fund, which is part of the government Clean Energy Fund, which has also supplied part of the funding for the operation. So don't worry about that. And as far as the funding is concerned, it's not linked to the EPA, the environment anyway, and it's just tick boxes, doing formalities. Always takes longer. These are talking about 1,000-page document or several thousand-page document, and it's all going through the fine-tooth comb, making sure all okay with the funders. Of course, it may drag on, but it'll get done. They're still confident of production in March, mid-February, March. So that's the main thing. Set your sights on that. Don't worry about all the documentation, all the admin side of it. Don't worry about that. It's not worth worrying about. This is a good thing. I don't know if you saw this. Warren Buffett's 20-slot rule. He said, I could improve your ultimate financial welfare by giving you a ticket with only 20 slots in it so that you had 20 punches, that's all, representing all the investments you could make in a lifetime. And once you'd punched through the card, you couldn't make any more investments at all. Under these rules, Buffett explains, you'd really have to think carefully about what you did, and you'd be forced to load up on what you really think about. So you'd do much better. It's conviction plays, You'd really research into it. You wouldn't mess around with trades. Sometimes I think shares are too liquid. People jump in and out, looking for 10, 20%. If you want to trade, but that's not where the good money, the good returns is really, If you look at the top 1,000 people, richest people in the world, have a look at how many people are traders. None. Have a look at how many are investors. Quite a lot. That just says a lot to me, says a lot. If you want to make big money, you've got to be an investor. There are some traders that have made good money, of course, but investing is where it's at, money-wise, multiples. So this is very good here. Look at this. So he says, you shouldn't just assume you're going to get 20 great ideas in their lifetime. If you look at business guys who have made it, like, for example, the EasyJet guy, let's be honest, one good idea, and that's all you need. And you try Easy Hotels, I suppose. Is that going well? I don't know if it is. There aren't many people, like Dyson, for example. One good idea is all you need. Got a billionaire off that. Investors, if you're less capital, you don't own the business so much, or as much of the business, you probably need a couple more ideas, of course. But the fact that they've got to become a listed company means it's a decent idea. It's got, legs. So, a bit of the filter, the quality filter has been gone through. But you shouldn't assume you're going to get 20 ideas in a lifetime. They can bet on 20 ideas, but only 3 or 4 or 7 might make them rich, he said. But what you can't do is get rich by trying one new idea every day. See, you stick with the conviction there, and do you know what? Generally, you can make money on any stock if you buy it right. If it's an excellent business, then of course you'll do very, very well. And this is what I said recently. And this is part of my internal thought process. I said, sometimes the next winner you're looking for is already in your portfolio. It's often very tempting to go looking for the next shiny stock. But it can over diversify your holdings and reduce your potential returns. Like I showed you that risk reward there. If you get too many holdings, you're never going to make good money. If you've got more than, say, 10 stocks, I believe, you may as well buy a fund. It's a lot easier, a lot more cost efficient, and buy the fund in dips. You're better off buying the dip on a stock you hold and believe in. Okay, so that's that. But I just want to cover a bit of news on companies I own. This is quite nice. On YouTube 2 weeks ago, I think, or 5 days ago, Ed said, I'm in the escape room industry. He's an owner of an escape room, and he wants to get another one, apparently. And by chance, found that Escape Hunt was a PLC when it was 9 pence. After a chat with some friends who understood stocks much more than myself, I decided to invest at 12.5 pence. They really look to be conquering the market. I believe their new sites in premium locations will be the real key to their success. I checked Ed out. Lovely guy. He has his own business. Tell me what it is. I saw him on YouTube as well, doing a sort of a walk around of one of his escape rooms there. So it's very interesting that Ed also wants to expand his business because there's a lot of demand there. But he also sees potential, of course, in Escape Hunt. So that's someone in the industry, I did this on the market versus Rightmove. If you're not on Twitter, you wouldn't have seen this, of course. It's a GIF, pretty much. And I said, Rightmove is valued at 62 times that of on the market. 62 times. So you got 5.7 billion against 90 million. But their revenue is only 9 times that of on the market. This is half years now. 9 times, yet it's valued at 62 times. 62 times, but their website is only 5 times that of the traffic they get their website. It's only 5 times that of On the Market. It's valued 60 times, but they only have a quarter more estate agents than On the Market, about 25-26% more estate agents on their books than On the Market. Is this justifiable? 60 times? Rightmove is valued 60 times, but On the Market is growing, whereas Rightmove isn't. Rightmove's revenue for the last 6 months dropped by 34%. Whereas On the Market grew by 28%. The gap is closing. The share price gap will be closing as well. It's at an 18-month high On the Market. I think when we get figures out on this end of this year, it'll do very well, I think. It's a buoyant market, for people rushing for stamp duty, but portals, are the way forward. And one other thing, On the Market is 65% owned by estate agents. Rightmove isn't. What does that say? Estate agents are more loyal to On the Market because it's not only they own a share of it, but it's cheaper. It's about a third cheaper On the Market. Rightmove charge about £1,000 per office, whereas On the Market charge about £300. And they do new and exclusives. So you often get properties coming out. Like I said, I've set up 2 filters exactly the same on each portal. And you often get new properties coming out on the Market before Rightmove, 24 hours before. And that's what you want. You want a new property to come onto the market, and you want a lead before the herd arrives to go looking for a property. So that to me is why On the Market will close the gap. That loyalty, the stock they have, and that exclusivity. And one more bit of news from the company owned Symphony Environmental. They launched Symfresh, a new reusable press and seal fruit and vegetable bag developed to keep climatic fruit and vegetables fresher for longer. Why? Because Symfresh bags are proven to extend the shelf life of fruit and veg by up to 40%. It's a huge cost, 40% the shelf life. So 1/3 of all food produced globally goes to waste. That's a phenomenal amount. When you realise how many people are starving in the world, 1/3 of all food produced goes to waste. In the UK, 34% of this wastage is consisting of fruit and veg. And also, by the way, this is D2P tech, but D2W tech, which makes it biodegradable, can also be put into these bags. Thanks for watching. By all means, click on my face, which is there, where is it? There? Yeah. And hit the subscribe button, notification bell, and then there's some other videos there to watch. Thanks very much. I appreciate you watching, sticking around for so long. I'll go now. I'm just talking nonsense and I'm just filling, really. So, pointless.